The best investment portfolio is the one that you can stick to during the good and bad times. As my grandpa used to say, an okay investment that you can stick with is better than the perfect one that you cannot. Okay, you caught me. He didn't actually say that, but I kind of wish that he did because it sounds like something that an old wise person would say. Regardless, I'm going to give you my top 5 ways to invest as well as the common criticisms associated with each. All of these portfolios will help you become a millionaire, but that's only if you focus more on growing your income instead of investment returns. Because, well, you don't have any control over your returns, but you do have full control over your income and how much of it you shove into these investments. Target date funds are the simplest set it and forget it way to invest because they automatically adjust from stocks to bonds as time goes on and you get closer to retirement. Think of them like a fund of funds. Inside each target date fund are globally diversified stock and bond funds, usually both US and international, so you're covered worldwide. Each TDF is based on a target year that you plan to retire, which makes it easier to figure out which one to invest in. For example, if you're between the ages of 42 and 46 right now, with about 20 years until retirement, the 2045 fund is set up for this type of person. Using Vanguard's target date funds as an example, here's a quick cheat sheet showing you how the allocations change from stock to bonds over time. As you can see, they start out at about 10% allocated to bonds and slowly increase until retirement when there's close to a 50-50 split. The main reason Vanguard does this is to reduce volatility and preserve portfolio value during the years when someone is retired without an active income. Keep in mind that anyone at any age can invest in any of these funds. There are no rules against it. If someone is, say, 60 and is okay with taking on higher volatility for a higher potential return, then instead of investing in the 2030 fund with 38% allocated towards bonds, he can invest in a 2050 through 2070 fund with only 10% allocated to bonds. A lot of nerds in the investing community like to trash on target date funds for many different reasons. And I get it, because I used to be one of those people. But they do serve a very valuable purpose for millions and millions of people who aren't that interested in anything investing, but understand the importance of it. I am by no means saying that target date funds are perfect. They have flaws just like every portfolio and every person, but they're pretty darn effective for what they're set up to accomplish for a certain part of the population. A big criticism that target date funds have is too much allocated towards bonds for younger people. Some of them would say that investing anything above 0% into bonds is too much. While I agree that younger people can afford the volatility that comes with a 100% stock fund portfolio during their working years, 10% in bonds isn't going to destroy their financial future. The next criticism also concerns bonds, but mainly with how quickly they ramp up the allocation. For some, jumping from between 5 to 9% every 5 years is too much, too fast, especially when every investor is in a different financial spot. Now, this can be avoided by selling out of a more conservative TDF than buying into a different one with a lower bond allocation that fits your personal needs. Another criticism is that there are terrible funds to hold in a taxable investment account due to the potential capital gains distributions of this type of fund. We saw this screw over a lot of people who held them in a taxable brokerage account back in 2022 when Vanguard made an internal change. If someone is going to invest in this type of fund, it should only be held in a tax-advantaged retirement account to avoid potential capital gains distribution issues in the future. Another criticism of target date funds is that to avoid additional fees, you have to match up the fund provider with its investing platform or buy them in an employer-sponsored retirement plan. Vanguard target date funds should only be bought on the Vanguard platform. Fidelity Freedom Funds should only be bought on the Fidelity platform. Schwab Target Index Funds should only be bought on the Charles Schwab platform. For example, if you like the Vanguard TDFs, but you dislike their investing platform, then it probably wouldn't be a good idea to purchase them on the Fidelity platform because they will charge you an unnecessary additional fee. Oh, and public service announcement, I would personally avoid the BlackRock iShare LifePath Target Date ETFs. They're basically actively managed ESG funds disguised as a passive target date fund like the ones offered by Vanguard, Fidelity, and Schwab. Lastly, some of them come with minimum investment amounts. There aren't any from Fidelity or Schwab, but Vanguard's has a $1,000 minimum, which is a little annoying. Now, if you like the idea of a hands-off target date fund but want to avoid the fund automatically automatically adjusting your bond allocation too quickly, a good alternative that I like is the life strategy funds. Like target date funds, these are globally diversified funds that hold the same four things: US and international stock and bond funds. The big difference is that the stock bond allocation with these will stay the same. Right now, they offer 4 of them with varying allocations that might fit your needs. An investor who wants to be extremely hands-off could potentially buy that 80-20 portfolio and ride it out for the rest of their life if they wanted. One of the common criticisms is that even the most quote-unquote risky life strategy fund is still 20% bonds, which some might consider to be too conservative. There's also no fund with an in-between allocation. It's a huge jump, going from an 80-20 to a 60-40 allocation if someone is getting older and wants to invest slightly more conservatively. If you prefer something like a 90-10 or 70-30 allocation, then it's not available. Another criticism matches up with target date funds. They're not very tax efficient and have the potential for unnecessary capital gains distributions, so you'd want to try to avoid holding them in a taxable brokerage account. The next criticism is that $3,000 minimum to invest. What in the world is Vanguard thinking here? I am blown away they still operate a few funds like this. Yes, someone can save up the money, then invest. But come on, $3,000 is a lot of money for some people, especially the people who need to start investing the most. If you are not a fan of bonds, then let me introduce you to another buy and hold, hands-off portfolio, a total world stock fund. In the case of Vanguard, it comes in 2 different flashy colors: ETF or traditional index fund. Am I allowed to consider investing in one fund a portfolio? I'm not sure, but this is my top 5 list, and it's my YouTube channel, so I guess I make the rules, and I consider it a portfolio. This is a fund that's designed to track the performance of the global stock market by investing in over 9,800 stocks across the world. By holding over 9,800 stocks, this fund includes stocks from various countries, covering both large and small companies across developed and emerging markets. It's market cap weighted, which means companies with a higher market value make up a larger portion of the fund. For example, large companies like Microsoft, Apple, Amazon, and Nvidia have a significant influence on the fund's performance because of their high market caps. Since it's passively managed, the fund manager also doesn't try to pick stocks that they think will do well in the future like they do in an actively managed fund. The fund will automatically rebalance across different stocks as market values change, so the investor doesn't have to do anything other than shove money in and forget about it. If you know you want to invest in 100% stocks while being extremely hands-off, then there couldn't be a more perfect fund than this one. This brings us to the first criticism though. International stocks have underperformed US stocks in recent years, so some might say that it doesn't make sense to invest in something that holds them. While this is true, and it's why returns from this type of fund have underperformed those of a pure 100% US stock fund, it's not really fair to compare. A person putting money into a total world fund has to remember that the point of investing in it is to diversify across the world based on market cap. This prepares and almost fully protects the investor from the unknown outcome of which stock or country will perform better in the future. I'm not going to go any deeper into the international investing debate because I laid out all of my thoughts in another video, which I will link down in the description below. If you are someone who hates international and only invests in 100% US stocks, that's fine. I used to be one of those people, so trust me, I completely understand where you're coming from. And at the end of the day, it's your money, and I'm not your daddy, so I couldn't care less what you do. Another criticism of a total world fund is that since it's a 100% stock portfolio, investors who are moving closer to retirement will have to manually add bonds to their portfolio. This isn't a huge deal, but the portfolio could need some personal management as you approach that stage of life. Also, since this type of fund holds 100% stocks, it exposes investors to more market volatility. For experienced investors who have gone through an extended downturn and have an idea of how they react emotionally, this isn't a big deal. But for the people who have only lived through a baby stock market drop, as we saw in 2020, it's still unknown how you'll react to a longer lasting downturn. Hopefully you don't panic sell, but you won't know until it's staring you right there in the face. Since this fund bases the US international stock allocation on the world market cap, one might criticize its weighting towards one side or the other. Right now, the weighting is about 60-40 in favor of US stocks, But even holding 40% internationally is a little too much for some people. I'm sure there's also people out there who might think there's too much allocated to US stocks. Since they've been outperforming for so long, they might be due to start underperforming. For the record, I'm not making a case for one side or the other, but that's just a criticism that I hear. If you like the idea of a total world fund but want more control, then a 2-fund stock portfolio is a good alternative and makes my top 5. It basically allows you to split a total world fund into 2 separate funds. This gives you more control and flexibility over how much you allocate to each, as opposed to allowing the total world fund to decide that for you. You can use a traditional index fund or an ETF version, and both are great choices for any type of investment account. For the US stock fund, you can use an S&P 500 or total US stock fund, but try not to hold both if you don't have to. It's not the end of the world if you do, but it doesn't make a lot of sense from a portfolio construction perspective. The 2-fund portfolio is a great starting point for someone who wants to diversify globally, but behaviorally doesn't feel comfortable going from 0 to 100 with an international allocation, or in this case, I should say 0% to 40% based on the allocation of the total world fund. Full transparency, this is how I personally invest across my entire portfolio. I used to be 100% US stocks, but started to slowly increase my international holdings. I think it was last year or the year before. Not sure where I'll end up, but as you can see in my Roth IRA, this year I'm slowly working my way up to 10% allocated to international for now. If you want to check out N1 Finance, which is where I have a few of my investment accounts, then I'll have a link in the description as well as a sign-up bonus. As much as I love the 2-fund portfolio, there are some criticisms. The first is that it's a little more hands-on with having to choose the allocation between US and international. This can be a little intimidating for some investors because everyone has different opinions on how much to put into each. If you're really not sure, then start out slow with something like a 10% allocation to that international fund, then slowly increase from there until you feel comfortable with an amount that fits your investing style. But remember that the closer you get to 40% international, the more you'll be like a total world fund. So at that point, it might make sense to buy that fund instead of building a 2-fund portfolio on your own. I want to reemphasize that the main goal here is to pick an allocation you're sure that you can buy and hold on to without panic selling at the first sign of underperformance from US or international stocks. Just like with total world funds, another criticism is that there's more short-term price volatility with a 100% stock fund portfolio. Yes, stocks are expected to give you higher returns, but the price you pay is having to stay invested during those times the market is fluctuating wildly in the short term. If you want a deeper dive into a 2-fund portfolio, then I'll link my video on it down in the description below. Now, if you like the idea of a target date fund, but want more control over how things are allocated over time, then a 3-fund portfolio is the next one in my top 5. It'll consist of a US stock fund, an international stock fund, and a bond fund. This type of portfolio will give you some of the best risk-adjusted returns because it combines all 3 of these funds. If you are not sure how to set up the allocation across those 3 funds, you can use a target date fund that you like as a starting point. So we can look at something like the 2070 TDF and go with 90% stocks and 10% bonds. For determining the US international stock allocation, you can refer back to what I mentioned in the 2-fund portfolio section a minute ago. What I like about a 3-fund portfolio is that it's easy to transition to if you start out investing in something like a 2-fund portfolio during your younger years. As you get closer to retirement and want to take on less risk, all you do is add 1 bond fund, then you're good to go. As with a 2-fund portfolio, one criticism of a 3-fund portfolio is that it's a little more hands-on since you have to choose the initial allocation and manage it over time. While it's not a ton of extra work and not difficult to do, it's still more when compared to something like a target date fund. Another criticism is that the 3-fund portfolio only includes 3 funds, obviously. Some of you out there prefer to add a few more funds based on your personal investing style. I know this portfolio seems too simple, but that is the whole point. To limit your holdings to the bare necessities, because adding more than that doesn't guarantee outperformance. I also have another video where I do a deeper dive into the 3-fund portfolio, which I'll link down in the description. Down there, you'll also find other helpful personal finance and investing resources as well. Hit that thumbs up button to help support the channel. Done.